GameStop was a joke. Then it became a movement. Then it became something even stranger, a cult.
In early 2021, an unexpected financial uprising shook Wall Street to its core. A struggling video game retailer, GameStop, became the battleground for a modern David versus Goliath shutdown. Small-time investors versus billion-dollar hedge funds. What started as a short squeeze on Reddit's WallStreetBets quickly spiraled into something much bigger. It wasn't just about making money anymore. It was about sending a message. A movement was born, a rebellion against Wall Street's unchecked power. And for many, it became more than just a trade. It became an obsession, a belief, a cause. But was this really a revolution, or the rise of an anomaly?
This is the GameStop Cult, an untold story.
Sit back and watch how it all unfolds. For years, GameStop was the place where gamers bought and traded video games. You could find a store in almost every mall. But by 2020, things weren't looking good. More people were downloading games online instead of buying discs. Game subscriptions made it easy to play without ever stepping into a store. GameStop was on its last legs. The company had announced mass store closures, struggling in an era of digital gaming. Wall Street noticed. Big hedge funds saw an opportunity. You must have heard about big hedge funds. They are investment companies that manage money for wealthy individuals and institutions. Unlike regular investors who buy stocks and hold them for the long term, hedge funds use aggressive strategies, like short selling, betting that a stock will drop in value, leverage, borrowing money to invest, and algorithmic trading to make profits quickly. Hedge funds didn't just bet against GameStop, they shorted it heavily, expecting the stock to crash. By early 2021, GameStop was one of the most shorted stocks ever. Hedge funds had borrowed and sold more shares than actually existed, expecting to buy them back later at a lower price. Imagine selling 10 tickets to a concert with only 5 seats, hoping that not everyone shows up. But if they do, you have a serious problem. That's what hedge funds did with GameStop. But deep inside an online forum called WallStreetBets, a different idea was forming.
For GameStop, as amateur investors take on hedge fund billionaires, prompting uproar and investigation, and also a class action.
To outsiders, these were just internet jokers. But inside the forum, they were planning something bigger, a fight against Wall Street. And then came the man who would become their leader, a retail investor who saw an opportunity where everyone else saw failure. Keith Gill, better known as Roaring Kitty, was a financial analyst. He was Roaring Kitty on YouTube and Deep Fucking Value on Reddit. He made a radical claim. GameStop was undervalued. And if enough people bought in, hedge funds betting against it would be forced to cover their positions, triggering a massive short squeeze. At first, people laughed at him. A failing video game store, worth investing in. Unlike Wall Street, he believed GameStop still had value. He put $53,000 of his own money into GameStop stock. Gill wasn't chasing a quick profit. He saw a company with loyal customers, a chance to bounce back, and, most importantly, a short squeeze waiting to happen. His belief spread fast. At first, people laughed at him. But then, the stock price started rising, and rising, and rising. The internet took notice. This wasn't just about money anymore. It was Main Street versus Wall Street. In essence, the regular people versus the big banks. And GameStop became their symbol. The squeeze was coming. No one thought GameStop would become the center of a financial battle. To hedge funds, it was a dying business, just another old-school retailer fading away. They bet big that the stock would crash. Too big. By early 2021, hedge funds had shorted more than 140% of GameStop's available shares. That meant they had bet against more shares than actually existed, something that almost never happens. Retail traders saw the flaw, and they didn't just push back, they fought back. Hedge funds thought it would be easy money. Instead, they walked into a financial disaster. Melvin Capital was deep in GameStop shorts. They had bet big, expecting the stock to crash. Then retail traders flipped the script. GameStop's price surged, 100, then 200, then 400. Hedge funds were trapped. By the time GameStop hit $483, Melvin Capital was bleeding money. Every second, every tick upward meant billions in losses. On January 25, 2021, Melvin had no choice. They closed their short position. The losses? Billions. But Wall Street doesn't let its own fail.
They're taking a non-controlling revenue share of the firm, of Melvin, as a way to help them get through these difficult times, providing some liquidity to the firm as they have seen performance suffer about 30% for 2021 through last week, largely due to, as I mentioned.
For retail investors who had just outplayed Wall Street, this wasn't just a bailout. This was proof that the system was rigged. As GameStop's stock price soared, a new figure stepped into the spotlight: Ryan Cohen. Cohen was the co-founder of Chewy, a successful online pet supply company. He made millions by building an e-commerce business, and when he bought a large stake in GameStop, people got excited. Why? Because Cohen believed GameStop could change. He wanted to turn it into a modern e-commerce business, just like he did with Chewy. Some investors believed Cohen was secretly sending them messages. He posted cryptic tweets, random emojis, pictures of ice cream, and memes that didn't seem to make sense. Some thought these posts had hidden meanings about GameStop's future.
And tells them what they need to be doing.
Anything he tweets gets deciphered.
The community analyzed every word, convinced he was guiding them toward the MOASS, mother of all short squeezes. Memes compared him to Moses, leading retail traders to the promised land of financial freedom. Some even called him Papa Cohen, seeing him as the ultimate leader in their fight against Wall Street. Even though Cohen never publicly supported these theories, his silence only made his followers more convinced that he was playing 4D chess against hedge funds. When he became GameStop's chairman, it only strengthened their belief. For many, Cohen wasn't just a businessman, he was a symbol of hope. A sign that GameStop wasn't just a meme stock, but a company with a future. As GameStop's stock price skyrocketed, trading platforms faced a major issue. Clearinghouses demanded billions in extra collateral to cover the extreme trading volume. But to retail traders, this wasn't about technicalities. This felt like a betrayal. Robinhood, the popular trading app, the app millions of small investors relied on, disabled the buy button for GameStop. Users could sell, but they couldn't buy. The price collapsed almost instantly. Billions in value wiped out overnight. Social media exploded with anger and theories. Robinhood was protecting hedge funds. Citadel, a firm tied to Robinhood, had financial relationships with Melvin Capital, the hedge fund that was losing billions on GameStop. Did they pressure Robinhood? This is market manipulation. Hedge funds could trade freely, but retail traders were blocked. Why? Wall Street changed the rules mid-game. The same people who preached free markets were now limiting trades when retail investors were winning. Robinhood's CEO, Vlad Tenev, later claimed the restrictions were due to clearinghouse deposit requirements. They simply didn't have enough money to settle trades. But to retail traders, the message was clear. Wall Street plays by different rules. Lawsuits were filed, accusing Robinhood of market manipulation. Congress launched investigations, with lawmakers from both parties demanding answers. Robinhood CEO Vlad Tenev, Citadel CEO Ken Griffin, and Roaring Kitty Keith Gill were called to testify before Congress. Tenev denied wrongdoing, Griffin denied influence, and then Keith Gill leaned into the mic. "I like the stock." The hearing didn't fix anything, no one was punished, but it exposed something bigger. Robinhood claimed it was due to liquidity issues. But to GameStop investors, this was proof of something much darker, an orchestrated effort to kill the movement. Conspiracies exploded overnight. Had Wall Street rigged the system? Were hedge funds pulling the strings? To the GameStop believers, the answer was obvious. And that's when it stopped being about money. The theory is simple. If every GameStop investor holds their shares indefinitely, hedge funds will eventually be forced to buy them back, no matter the price. A short squeeze happens when short sellers who borrow and sell shares, expecting to buy them back cheaper, suddenly have to buy at much higher prices. That demand drives the stock even higher. The MOASS theory claimed that hedge funds wouldn't just lose, they would be forced to buy at any price. The demand would skyrocket, and with demand comes exponential price increases.
GameStop could be worth $1,000 a share.
$750,000 a share, $900,000 a share.
GameStop is a nothing company.
GameStop isn't worth just $100 per share, or $1,000. Some claim it could reach $900,000 per share. To outsiders, this is madness. To believers, it is fate, a financial reckoning. The downfall of Wall Street, a moment in history where the people, the retail investors, take back control. As mainstream analysts dismiss the idea, the GameStop faithful double down. They analyze every piece of data, decode cryptic tweets from Ryan Cohen, and wait for the inevitable. They call it MOASS, the mother of all short squeezes. Hedge funds must cover their positions eventually. When they do, the investors who held strong will be rewarded with a fortune beyond imagination. To some, this is a ticket to financial freedom. To others, it is about sending a message to Wall Street. We won't be played anymore. But the wait is excruciating. Every dip in the stock brings panic. Every hedge fund maneuver is seen as a deception. Some investors go all in, risking everything for the dream of MOASS. The media calls it a delusion. GameStop investors call it the greatest rebellion in financial history. And so, they hold. And they wait. For the day GameStop reaches unfathomable heights. For the day the hedge funds collapse. For the day the world finally sees the truth. For the day of mother of all short squeezes. Finance has always been controlled by Wall Street analysts and billion-dollar firms. But in early 2021, the power shifted. Platforms like Reddit, Twitter, YouTube, and Discord became battlegrounds where everyday investors, students, office workers, and retail traders took on hedge funds. What made this movement so powerful? It wasn't just numbers on a screen. It was community, emotion, memes. At the center of it all was r/WallStreetBets, a chaotic, meme-fueled subreddit where financial strategy mixed with rebellion. This wasn't about traditional investing, it was about fighting back. Retail traders discovered that hedge funds had aggressively shorted GameStop, betting billions on its failure. Instead of backing down, they turned GameStop into a symbol of resistance. They weren't just buying stocks, they were waging war. What made r/WallStreetBets different? It wasn't just investing, it was a movement. It wasn't about profits, it was about making Wall Street pay. And most importantly, it was fun. Finance has always been intimidating and exclusive. Not anymore. Through memes, the GameStop movement made complex financial concepts easy to understand and impossible to ignore. Some of the most iconic phrases: apes together strong, retail traders standing united against Wall Street, diamond hands, holding the stock no matter what, GME to the moon, the dream of sending GameStop's price sky high, HODL, hold on for dear life, the ultimate rallying cry. These weren't just jokes, they kept morale high. They kept people holding, even when the stock price swung wildly. Without meme culture, the GameStop movement might have died early. Instead, it became a full-scale financial rebellion. Twitter, YouTube, and Discord spreading the fire. Reddit was the headquarters. But Twitter, YouTube, and Discord took the message global. Twitter, Elon Musk's one-word tweet, GameStonk, linked to WallStreetBets and sent the movement mainstream. Celebrities, influencers, and traders jumped in. YouTube, Roaring Kitty, Keith Gill made deep videos explaining why GameStop wasn't dead and why hedge funds were in trouble. His conviction inspired thousands. Discord, chat rooms became real-time war rooms. Traders coordinated moves, tracked hedge fund losses, and reacted instantly. Wall Street had no choice. What started as a small Reddit movement became a global financial riot. Millions of people, many investing for the first time, jumped into the market. But to take them seriously, investing is usually simple. Buy when prices are low, sell when they're high. But GameStop was different. It wasn't just about making money, it was about proving a point. Retail traders saw themselves as underdogs fighting against a system that felt unfair. Hedge funds had made billions betting against struggling companies. This time, regular people wanted to turn the tables. Every GameStop share became a symbol of defiance. Even when the stock shot up from under $20 to over $400, many refused to sell. News outlets called them reckless. Experts warned the stock was overpriced. But instead of selling, they held on even tighter. For them, this wasn't just a trade, it was a fight. And emotion, not logic, kept it going far longer than anyone expected. What started as a way to outsmart Wall Street quickly turned into something bigger. A rebellion fueled by emotion, community, and frustration. For many, this wasn't about getting rich. It was about standing up to a system they believed was unfair. GameStop became a symbol of a broken economy, exposing deep frustrations over wealth inequality, corporate greed, and Wall Street's control over financial markets. Most of the traders behind the movement were young, millennials and Gen Z, people who had grown up watching Wall Street get bailed out while everyday people struggled. To them, Wall Street meant the 2008 financial crisis, when big banks crashed the economy but got rescued while millions lost their jobs and homes. Soaring living costs, rent, college, and everyday expenses kept rising, but wages didn't keep up. A rigged system, hedge funds seemed to play by their own rules while small investors were left behind. By holding on to GameStop stock, retail traders sent a message. This time, Wall Street wasn't going to win. One of the most fascinating aspects of the GameStop saga was the psychological forces that drove it. Unlike traditional investing, where decisions are based on careful analysis, the GameStop movement was heavily influenced by group psychology. Groupthink played a massive role in the movement's momentum. On platforms like WallStreetBets, thousands of investors shared the same beliefs, reinforcing each other's confidence in GameStop's rise. Movement wasn't just about making money, it was about being part of an internet subculture that felt like a revolution. Dissent was discouraged. Anyone questioning the movement was often mocked or dismissed as a shill working for hedge funds. Holding became a virtue. Investors were encouraged to have diamond hands, meaning they wouldn't sell under any circumstances, even as the price fluctuated wildly. Memes and inside jokes created a sense of belonging. The movement wasn't just about making money, it was about being part of an internet subculture that felt like a revolution. FOMO was another powerful driver. As GameStop's stock price soared from under $20 to over $400, more and more people wanted in on the action. Media coverage fueled excitement, drawing in people who had never invested before. Social media posts of massive gains encouraged others to buy, afraid they'd miss their chance to profit. The movement felt historic. People didn't want to miss out on what could be a once-in-a-lifetime financial uprising. But FOMO also led to irrational decision-making, with some investors pouring in their life savings, taking out loans, or maxing out credit cards just to buy GameStop stock. The The GameStop saga blurred the line between investing and gambling. Retail investors realized they could shake Wall Street, but many were driven by emotion and high-risk bets rather than strategy. Stock swings felt like a casino. Prices soared and crashed within minutes. Memes like YOLO fueled reckless risks. Traders justified losses as part of a movement. Some became obsessed, constantly checking prices, doubling down and refusing to sell. Their influence didn't stop with GameStop. Retail investors targeted struggling companies like AMC and Bed Bath & Beyond, hoping to repeat the squeeze. Wall Street took notice, adjusting strategies to avoid future upsets. Although GameStop's stock price eventually stabilized, its impact on the financial world continues to be felt. The event led to increased scrutiny of short selling, trading restrictions, and the power dynamics between retail investors and hedge funds. But the ripple effects extended far beyond GameStop itself. And this led to regulatory changes and market reforms. The GameStop frenzy caught the attention of lawmakers and regulators worldwide. In the aftermath, new proposals aimed at increasing transparency in short selling and limiting conflicts of interest between hedge funds and market makers. The SEC and financial watchdogs began reviewing practices around naked short selling and dark pool trading. GameStop didn't just survive the movement, it used the momentum to reinvent itself. Under new leadership, the company shifted its focus from retail stores to online business. E-commerce transformation, GameStop invested in digital sales, hoping to compete with giants like Amazon. Instead of relying on physical stores, they pushed online gaming gear, collectibles, and digital downloads. NFTs and blockchain. GameStop tried to jump into the world of NFTs, non-fungible tokens, and blockchain technology. They launched an NFT marketplace, betting that digital collectibles would be the future of gaming. But as the NFT craze faded, so did interest in the platform. Despite the challenges, investors from the GameStop movement never gave up. A new strategy, activist investors, many of them retail traders, pushed for changes to keep GameStop relevant in the digital age. Stockholder loyalty. Some investors held onto their shares not for profit, but as a symbol of defiance against Wall Street. Finance became more accessible. More young and first-time investors entered the stock market, influenced by social media and commission-free trading apps. Meme culture and investing intertwined. Financial memes became mainstream, with humor and community-driven trading shaping market trends. Distrust in Wall Street grew. The event reinforced skepticism toward hedge funds, market makers, and the financial system. And in all of this, GameStop was more than just a stock. GameStop was more than just a company. It became a symbol of financial rebellion. While some saw it as a speculative bubble, others viewed it as a movement that exposed deep flaws in modern financial systems. Years later, the question remains, was GameStop the beginning of a retail investor revolution, or just a glimpse into a chaotic new era of trading? The saga was reckoning, a moment where everyday people dared to challenge an untouchable system, the wealthy and big banks. Was this a true revolution, or just a fleeting spark? One thing is certain, it was a statement. A symbol that retail investors are no longer passive spectators in a game rigged against them. The rise of digital activism in finance has made one thing clear. The rules of Wall Street are no longer written by hedge funds alone. The rise of digital activism in finance has made one thing clear. The rules of Wall Street are no longer written by hedge funds alone.
The media called them reckless. Wall Street called them fools. But history? History will remember them as the ones who made the financial world stop and listen. In the end, GameStop's legacy isn't just about stock prices. It's about power. Who holds it, who loses it, and who dares to take it back.
And as long as there are traders willing to fight, the question remains, was this the end of the rebellion, or just the beginning?
If you enjoyed this video and want more untold stories of financial revolutions, hit that like button, subscribe, and turn on notifications. There's always another story waiting to be uncovered.